How are you trading oil in this crazy times where we have seen negative $40 a barrel? Hey, I'm Chris Gunnels, and I've been trading options in the stock market for over 5 years now. And it has given me the ability to live the life that I want to live. I want to take a few minutes today and teach you how I'm trading oil. I'm selling put options, and when you sell a put option, it's just a simple way or another way of saying that you are selling insurance on the underlying stock. These put options that I have sold today are in USO, which is an exchange traded fund for the oil market. And what I ended up doing was I sold the $2 puts, about 4 of them, I believe, 4 contracts. Just so you know, each contract is worth or is about 100 shares of the underlying asset. So basically, so each contract I'm controlling 100 shares of that underlying asset. So since I sold 4 of the USA puts, the $2 puts, I now control 400 shares of USO. Now, the reason that I did that was because if you look at the implied volatility, which is huge when you're selling options, you're looking for implied volatility that is really high. In this case, because oil last night came down to negative $40 a barrel, today the implied volatility for oil was huge. I believe it was like 450%. And so I was telling myself, you know what, the odds are in my favor. The implied volatility probably is going to come down. It's a $2 put. USO can't go below zero. So I'm risking about $200 on each contract. Although I'm also getting paid that premium that I sold for those $2 puts. So really, my actual risk is less than $200 per contract. But I want to get back to what I mentioned a second ago, implied volatility. The idea of it going down from 450% is a big deal when you're selling options. And the reason why is because I sell options at a high premium. When implied volatility is high, options are expensive to buy. And so that it benefits me because when I sell an option, the person buying it is going to pay me a higher premium. And what's nice about that is over time, when things start to settle down, the implied volatility is going to go down. And what that means, I will be able to buy back the $2 puts at a lower price than what I sold them for. That means I will be able to keep the premium, or at least the difference. It's kind of like an arbitrage game. Well, I hope you enjoyed this daily recap of my options trades and that you will consider subscribing and following me. If you did find value, please go ahead and share this with your friends on Facebook, on Twitter, on Spotify, on whatever social platform you're using. Thanks. Bye.